Hello, everybody. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive on a week when we couldn't be more excited here as lovers of all things macro when they hit the market and move prices, because we are looking at what is an absolute bonanza of central bank activity, punctured through the middle by a very, very anticipated announcement from the central bank of all the central banks. No, I don't mean the Bank of International Settlements. And if you're a central bank nerd, you got that joke. But the Federal Reserve, they're due to make themselves heard this week. And what we're going to do here is go through what is really expected for all of the major central banks that are due to speak this week. There's 4 of them. And we'll look at it chronologically here. We'll start in Japan, go to Australia, then to the US, and finish out in the UK. All of this will be something that we look at in more granular detail as we go through the week. So tomorrow we'll really dial in on the Fed. Of course, the Bank of Japan and Australia come to us today within the next several hours here. So that those moves on the docket more immediately. We'll spend some time there. And then we'll talk about the Fed on tomorrow's show. Make sure to check that out. We'll go into more detail. Then we'll talk about the Bank of England the following day. So lots and lots and lots of central bank activity on the menu this week. But without further ado, let's jump into what is the immediate concern facing us right now. And that, of course, begins in Japan. The expectation is that for the first time in years, the Bank of Japan will come off negative interest rates this week. As it stands, the policy rate is at negative 10 basis points, negative 0.1%. And you can see here already in the overnight index swap implied rates that you see baked into the markets. 1 month out, you are at 0, which essentially means that the markets have fully priced in that we are going to get this rate hike from the BOJ. So this much is not a surprise. The surprise would be if the BOJ didn't raise rates at this meeting. The BOJ, of course, moves in 10 basis point increments, not the 25 basis points that most other central banks use. So what we have here is a move from negative 10 to 0. And as you can see here, over the course of the next year, we're expected to arrive somewhere at 1 rate hike on top of that. You can see we're basically at around 15 basis points on the 1-year OIS. So a year from now, we will have seen 1 hike, the markets think, on top of what we are going to get here. And then over the course of the next 2 and 3 years, we're going to see an increase of about 10 basis points a year, give or take. So obviously the pace here is very slow. Obviously the values here are a pittance relative to the kind of rates north of 3 and 4% that we see for other major economies. Having said that, this is the only central bank that's not expected to cut this year and is pointedly going in the opposite direction. So the key question here is going to be, let's say everything works out exactly as expected, and the timing of the hike is in fact now. It's been widely set up this way, and the expectations are, of course, so focused on it being now because we've just concluded the annual wage negotiation period, the so-called shunto, for major Japanese corporates, and they, for the most part, gave workers and unions everything they were asking for. So the inflation that had been really the source of imported food costs, and with that, the rise in the cost of living in Japan over the past several years, has scope to be locked in here. It was going in a process whereby things were receding, and so it didn't look like the Bank of Japan needed to move in a hurry. But with this change in wage structure that ostensibly locks in the cost of doing business as higher now, the logic of being at negative rates is less obvious. And so going up to zero, all the way baked in now. The key question is whether the BOJ will do anything else. They are still buying a massive amount of assets and expanding their balance sheet. They are still maintaining a cap on the 10-year government bond yield at 0%. Now, what we find is that the cap on the bond yield has basically aged into obsolescence already. And so what you've seen is, of course, since the start of the hiking cycles in much of the world in 2021, the yen has weakened considerably because yields everywhere were going up and not in Japan. So you see the yen has considerably declined since then. And then as the spotlight has now changed in the direction of starting to cut rates, the yen has stabilized and seems to be finding something of a bottom, perhaps. What we find is that the real surge in the yen started to occur right here. And this orange line, that's the government bond yield. The cap was at 0 with a threshold of allowance up to 25 basis points. The blue line here is where the markets thought the 10-year rate should be, if not for the Bank of Japan's intervention. And you can see here that while the spread was 0 and up to 25 basis points, so within the thresholds allowed by the BOJ, there was really no stress here until this broke out to 50 basis points. And what the Bank of Japan had to do was basically acquiesce and say, you're right, markets, and create a wider band. And so you saw a very sharp rise in the yen when that was occurring. So right here, you can see the 10-year yield struggling to hold this 25 basis point line until right here, the BOJ acquiesces and says, okay, fine, we'll widen it out to 50. Since then, they've widened it out to 100 basis points, so 1% on either side of 0. But because the pressure on yields has essentially evaporated along with the Fed's own intent to hike rates, that's really been the focus in Japan, is when the Fed hikes, because of the ubiquity of the US dollar, interest rates go up everywhere because the borrowing costs of dollars go up everywhere, and the dollar is the commercial unit of exchange the world over. So it doesn't matter that an economy isn't using dollars as legal tender. The cost of everything it buys, especially in the case of Japan, where it imports so much food and other commodities, that's denominated in dollars. So if the cost of dollars goes up to borrow, and the cost of borrowing goes up because that's the vehicle lubricating most all economic activity mostly everywhere, unless you want to talk about something like a North Korea, let's say. And so once the Fed stopped raising rates, the pressure abated. And you can see now it's a mere 13 basis points, less than even 25. So this policy of capping yields has essentially run its course. It's basically moot at this point. And so maybe the Bank of Japan takes the extra step of officially sunsetting it here, and maybe they don't because there's really no need to say anything. It's essentially an afterthought already. But if the Bank of Japan does decide to make it official, or decides to reduce the number of asset purchases that it wants to make, and it's not just a rate hike, but something else as well, well, then perhaps the yen finally gets the juice to bounce from these levels and really make its way higher and start to unwind this large decline. Next, we have the Reserve Bank of Australia. No change in rates here either. And if we take a look at what is being currently anticipated, we don't get a cut from Australia's central bank until basically the end of the year. So we're at 4.35 on the RBA cash rate now. And you can see that you don't really get to seeing a full cut until perhaps September, November. Even in September, it's more likely than not, but still not quite fully baked in. By November, it is. And if we look at the full stock of rate cuts now on the menu, it's 36 basis points by year end, which has been, of course, a significant adjustment from where we were at the start of the year, where the markets thought something like 1.5% in cuts were coming. Now it's 1 with a slight optionality for a second. You can see that the way that this has evolved is we are now a little bit more dovish than we were toward the end of last year, as far as at least the direction of the curve, but less so than we were when the RBA announced policy in February. And so when we consider what all of this amounts to, it seems like the general sort of trajectory here lends itself to a surprise in a dovish direction, because what we've seen since the RBA met in early February is economic data has gotten worse relative to forecasts. And of course, the most eye-catching of that data has been inflation, which has undershot expectations. Not on the more closely watched quarterly reading that the RBA takes into more of an account, but the monthly reading. But nevertheless, things have been soggier. And so the direction of travel here seems to be for the RBA to perhaps change the tone of its rhetoric, not necessarily sort of jump into rate cuts immediately, but perhaps to just dilute the level of hawkishness that's in the official rhetoric, in the statement that Governor Michelle Bullock will release following the outcome. And with that, perhaps we get closer to the expectation of 2 cuts. At this point, that's only about a 56% chance here at 36 basis points. So only about 14 of the 25 basis points needed for a second cut are being baked in here. And so what we'll look for is for that adjustment to then weigh on the Aussie dollar, if that's the way that we evolve here. Then, of course, there is the Fed. And here we have what is easily the biggest announcement of the bunch this week, because, of course, as we just mentioned, this sets not only the trajectory for borrowing costs in the US, but for the most part, globally. Virtually no chance that we get a cut at this meeting. In fact, you can see that we have basically the same rate baked in for the front month Fed funds futures here as the policy rate. We stay there through May. We don't get very close until, or very far, rather, in June, July. We really have to be, it looks like, in September to start seeing cuts. And herein sort of seems to be the main issue here. Of course, markets have been suspect of the Fed's ability or desire to wade into the gravitational pull of the autumn's electoral fireworks by starting to move on rates so close to an election in September. They've argued that June is the time, and if it's not June or at worst July, it's November and December, both of which are coming after the election. If we then look at how this has worked out for markets, we can see here that when we started the year, the markets thought the Fed was going to do 6 cuts, at one point even spiking to 7. That has been working down as U.S. economic data has looked better than expected. But as long as there was a sort of wedge of expectation for cheaper money in between where the Fed set their baseline at 80 basis points in December and where the markets were, it still looked like a tailwind for risk taking and a tailwind for stocks. And you can see stocks kept going higher through this whole phase because, of course, money still looked cheaper in the future. And the markets expected for that to get reflected in assets. So stocks go up until we get to a point here where we hit the Fed baseline and now move, as of today, to 61 basis points, which would make that third cut look less likely than 50%. So as of now, market expectations are actually flipped to the hawkish side of the Fed baseline. If the Fed says 80 basis points, that is 3 cuts with some rounding error. At 25 basis points apiece, 75 basis points is 3, 80 rounds it slightly. At 61 basis points, the likelihood of that third cut is now less than 50%. And we can see as we've gotten here, markets have stalled. The S&P is idling here. NASDAQ is looking a little bit soggier. It's actually attempting to move down. So the key question really, since the Fed isn't expected to change rates, will be, do they acknowledge what the markets have done? And does the green line we see on the chart here now move in the direction of 2 cuts? Do we go, broadly speaking, from 80 to, let's say, 50 or 55, where we're looking at 2 cuts being baked in with optionality on a third, but a less than even likelihood of that third move occurring? And if that happens, does the dynamic fundamentally invert? Are we then in a world where equities and the dollar have to adjust to an environment where the markets now have to reckon with a tighter Fed and with cuts then coming after the election, and so significantly delayed relative to what the markets have been thinking, really since this blistering rally started back in late October, early November, because, of course, as we can see here, it was initially powered by rate cuts building out. You can see as more rate cuts come in, stocks rise. And then from the start of the year saying, well, there's still more cuts than the Fed thinks. We're still good. We're still good. We're still good. Maybe we're not good anymore. And so with that in mind, this presents what is probably the biggest risk across the major financial markets. If the Fed endorses this, then we might have a stronger dollar, weaker stocks, weaker gold, weaker Bitcoin. And the real question then becomes, what happens to bonds? Have the bonds already priced that in? And so do they rebound? Or is there more room for yields to advance higher, perhaps if the Fed leapfrogs markets and gets even more hawkish than the markets are currently anticipating? And finally, the Bank of England. It too is expected to keep things on hold the current bank rate 5.25%. The first cut fully baked in at this point for August. Another one fully baked in for November. And so November, December, we can see that there's a bit of optionality on a third cut, but it is truly a pittance. In fact, we can see here the markets are pricing in 53 basis points in cuts. That's only 3 basis points more than exactly 2 cuts. But as it happens, as with Australia, in the UK, we've seen economic data start to move more so in favor of the doves. Wages are slowing. The survey of inflation expectations that the BOE just released on Friday is expected, has already shown, as a matter of fact, that inflation expectations have receded. And inflation data, CPI inflation data, due out earlier this week ahead of the BOE, is expected to show a rate of 3.5%, which would be the lowest since September of 2021. So perhaps then what you get is a reshuffling of votes. The way the Bank of England does it is there's 9 policy members and they all vote. What we've just had recently has been a run of votes, 6 out of 9 for standstill, 1 vote for a cut, and 2 votes for hikes. If we get some of those hikes moving into the no change camp, so if we, let's say, have 7 votes for no change or 8 votes for no change, or we get perhaps a few more votes for cuts with a vote shifting away from hikes, well, then again, we could get into a place where the British pound would suffer because the baseline will have shifted in a more dovish direction. And that is macro money for today. As I say, we'll delve into all of this in more granular detail, piece by piece, as the week goes on. We're here Monday through Thursday, right after overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what it might mean going forward. Back on with Chris for Futures Power Hour on Friday, on with Tom and Victor for First Call Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform known formally as Twitter, at Ilya Spivak. Thanks very much for joining. Stick around. There's more Tasty Live after this. Take care.